Like Jasmine, perhaps in a few words.
Sure, happy to start. So just by way of background, I am a chartered professional accountant. I've been in the field of accounting for over 23 years now. I started off as an auditor. I then worked in corporate finance. And the most recent 10 years of my career have been focused on enterprise risk management, ethical conduct, behaviors, as well as compliance, so financial crime compliance. When we started our conversations, just to get to know each other before the panel today, I shared a little bit of background as to why I pivoted from accounting to ethics. Well, when I started my career, finishing university, the first job offer I received was from Arthur Andersen. So I don't know if anyone remembers Arthur Andersen and the Enron scandal and everything else that happened. So that was my first taste of corporate life. Got a job offer, that was rescinded. Arthur Andersen was no more. And then whilst I was working in corporate finance, the GFC took place. And that was another pivotal moment. Everything stopped. We were afraid of what would happen next. Would we have a job in the next 6 months, 12 months? Were things going to recover? And so these were things that have had a lasting impression on, if I had to go back to the drawing board, what would I do with my career? And it got me really interested in enterprise risk management, corporate governance, and eventually ethics, and then championing ethics. So now being the ethics officer, I'm really proud to be playing that role within Deloitte, and also being part of panels like this to share ethics and experience from talking about conduct and behaviors and compliance, etc.
Perfect, thanks. Thanks a lot, Jasmine. Melanie, perhaps if you could also present yourself, perhaps if you could explain to the audience your role as a head of responsible investment at RBC GAM.
Absolutely, and thank you so much for having me here. Really delighted. It's been a really nice event so far. By background, I'm a lawyer by background, so I did my undergrad in science, and then I went into law at U of T. And from there, I worked at our regulator, the Ontario Securities Commission, and did securities litigation. So on the enforcement side is where I started out, and I did some criminal prosecution work as part of that. And then after a number of years, I went over to BMO, and I worked in the legal team at BMO, and primarily I was focused on fraud at BMO, supporting the personal and commercial business, so the special accounts management unit, kiting schemes, that type of fraud that we saw there from the legal team. And then about 12 years ago, I had a former colleague that I had worked with who had asked me to join RBC GAM. And in the ESG space, as it was sort of a new team that was being developed, but there wasn't enough work to really support all of my time. So I spent about 20% of my time doing the ESG, the responsible investment work, and the other 80% doing things that related to my legal background, regulatory audit type work at the asset manager. And then actually for a period of time, I stopped doing the ESG and I did strategy. I worked for our CEO at the time. We did a strategic alliance with BlackRock during that time, and that was extremely exciting to work on. And then about 7 years ago, I came into the role that I'm currently in, which is head of the responsible investment team. And what the responsible investment team is at GAM is we're 16 people, 6 in London, 2 in Vancouver, 1 in Minneapolis, the rest in Toronto. And we support all the investment teams in their decision making with environmental, social governance issues, and how they should be thinking about them, how they could incorporate them as part of their investment processes. Ultimately, they make the investment decision, they own that, but we provide them with research, expertise in these different areas to help support them. And so an example is I have someone on my team who has deep expertise in climate and climate change, climate metrics. And so we can run portfolios, we can analyze portfolios, we can think about portfolios. If a client says, I want to have a portfolio that has a certain weighted average carbon intensity, we can look at it and say, well, what's that going to mean from a return perspective? And we can do that type of work. We have people on my team who are very deeply involved in CEO compensation is another one, and the metrics and the appropriateness of different CEO compensation and pay package structures. And we also do all the proxy voting for the firm. We work with our investment teams very closely on that type of work. So it's a fairly broad mandate, and we're not shrinking our team anytime soon, despite changes in the industry.
Thanks a lot. Perfect. So Finally, Sebastian, if you could perhaps speak to about your position at ICPM, perhaps, and also about the research that you conduct at McGill.
Yeah, and thank you, Paul, and thank you for the invitation to come today. I'm Sébastien Béthermier. Good afternoon, everyone. I'm a finance professor here at McGill. I've been at McGill since 2010. I came to McGill actually doing research on household finance. Understanding the life cycle portfolio planning of investors. And over time, it became really clear that the big missing gap was retirement. There's a lot of pension shortfall around the world. In my view, there's a demographic crisis on its way in the coming years. And so I have a whole research angle on that, and another research angle in parallel on sustainable finance and responsible investing. And so over time, I've brought the two of them together. I teach courses on pension funds and retirement systems. I have some former students here in the room. And about 3 years ago, I took over the head of the International Center for Pension Management. And that's a global community of, 54 of the world's largest asset owners. You have the largest pension funds like the CPP, the Ontario Teachers, the PSP. But not just in Canada, they'll be in Australia, in New Zealand, in the Netherlands, in Norway. It's been fascinating. Together, they manage about $8 trillion. Right? And so it's been fascinating actually to see the challenges that they face, especially on the topics of responsible investing, but also more generally the role of pensions in society, the social role, societal role of pensions in society. And so that has very much been the research angle to date.
Perfect. So thanks a lot. Now that the introductions are made, let's jump right in. So finance and social responsibility beyond the balance sheet, it's a very broad question. As an academic, I prefer narrower questions, so I subdivided the panel into 3 questions. So first we are going to to discuss whether finance should look beyond the balance sheet. Then we will talk about how should finance look beyond the balance sheet. And at the core of the discussion there is the notion of responsibility. So in the last part of the panel, we'll talk about social responsibility, but social responsibility toward whom, all right? So that's going to be the structure of the panel. So first I want to go back to the basics and really talk about whether finance should look beyond the balance sheet. And I mean, I want to ask that question because if you had asked that question to Milton Friedman 60 years ago, he would have said no, there would be no need for a panel actually, he would have said that no, the objective of corporation is simply to maximize shareholder value, as you probably know. And I want to kind of come back to that point because I think it's going to be interesting for us today. And I want to talk about his argument actually. The argument that Milton Friedman is making is not that we should not care about ethics. What he's saying though is that it's not the corporation's job. I think the argument can be summarized this way. If you give $1 to plant trees in Amazonia, it has the same impact whether you as an individual you're giving that money or whether the dollar is given by a corporation. It has the same impact at the end of the day on the trees in Amazonia. And as a result, the most efficient way to get organized is to have the firms maximize shareholders' value, return as much money to shareholders. And if you care about trees in Amazonia, well, you should just donate. And if you are not interested in that, you should not donate. And that's the most efficient way to get organized. All right? And so I think that's interesting as a benchmark. It's interesting to think about that argument because it kind of tells us why there might be a reason for finance to look beyond the balance sheet, to care about ethics. In the argument of Friedman, the individuals and the corporations, they have access to the same action. They can donate to plant trees in Amazonia. But in practice, as a finance company, you can do some things that individuals cannot do. You can first convince companies not to cut trees in Amazonia, or you can decide not to finance companies that would cut trees in Amazonia. So that's, in some sense, finance is uniquely equipped to serve the public good. It has a unique role. It has a comparative advantage in serving the public good. The other reason why finance might want to look beyond the balance sheet is that it might be actually another way to maximize profits. After all, if, I don't know, you're a commodity trader, you need to have functional commodity markets. You need to have you need to be able to trade on crops. And so preserving Amazonia, it might actually be a way to preserve functional commodity markets. So in some sense, doing good might be a different way of doing well. All right? So in the first part of the talk, I want to kind of talk about those two arguments, talk about those two reasons why finance might actually want to look beyond the balance sheet. And I want to start with this idea of comparative advantage. One thing that finance companies can do, which that individuals cannot do, is to convince firms to change their governance. So we saw, for instance, that Californian pension funds, they managed to, in 2011, they managed to convince Apple or big companies to adopt majority voting. So this is something that you, as an individual, would not be able to do. So I want to open the floor and really discuss this idea that finance has a comparative advantage in serving the public good. And I want to have your opinion about why is finance uniquely equipped to look beyond the balance sheet. Perhaps, Sébastien, you want to start?
Yeah, so it's a great question. I love how you're going back to the fundamentals first. If we think about the role of investors, or the role of individuals as a whole, as a community of investors, we can drive change in two ways through our investments. The first is we choose which companies to invest in, right? And so in doing that, we allocate capital more towards some firms more than others. So let's say greener firms. If we have a preference for green firms, we'll push more capital there. We're going to affect the cost of capital of these firms, and then the firms will respond to that. The other way that we affect it is once we buy the firms, we are the owners of the firms, right? And we don't often talk as much about that. In fact, even some of the large funds will spend much more time on the investment than the stewardship function as the asset ownership of it. I want to ask all of you, how many of you own stocks in your portfolio directly? Raise your hand if you do. Okay, the majority of you. Keep your hands up, actually. How many of you are actively responding to voting requests for nominating directors? 1, 2, 3, 4. We went probably from about 40, 50 all the way down to 4. I don't do it myself either. I receive them. It's painful to do. I have a lot of work to do. I know I'm a tiny owner, so I'm not going to have any impact myself if I were to do it. But as a result, we collectively don't do it. It's a bit of the tragedy of the commons. We have a coordinated problem, which is what you're referring to. We could do it actually, but we know that we're going to have such a small impact that ultimately we end up not being engaged, right? And so there's a huge value in the way we structure the financial systems. Going back, for example, to the pension funds, when you have large pension funds like CalPERS managing $300 billion, they can act on our behalf. They have a lot more means themselves. They can hire a team to review, identify, do the due diligence on the directors. They have the power to do it. So when the Norges Bank Investment Management, that's the big sovereign wealth fund in Norway, they own 3%, 2 or 3% of all the stocks around the world. Well, they have the muscle to do it that we individuals often do not. Right? And so there you actually have a huge ability to make change, to be long-term, if you structure the system in a way that allows us collaboratively to do so. But I'm finding that the big push toward massive diversification, going for very cheap investment product, as great as that is, has made us focus so much on the investment and the portfolio itself that we actually don't think about our role as investors. And a lot of that, as a result, that impact is melting away.
I see, Melanie, do you want to...
Yeah, absolutely, and I think it's really interesting that you started out with the shareholder, the doctrine of shareholder primacy, and Milton Friedman. A number of years ago, when the Business Roundtable, including Larry Fink, came out with a letter and said, shareholder primacy includes other stakeholders too. It's not just about shareholders. We need to think about, employees, other communities, and everybody who's affected by the companies and what they're doing. And there was a lot of conversation at the time in industry about what does this mean? Is the doctrine of shareholder primacy dead? Or is it actually that it was just never so black and white and clear in the first place? And I'm of the view that actually, and I work for RBC Asset Management, we are a shareholder. So we have a very vested interest in saying that shareholder rights should be the dominant force. But I don't think that it was ever black or white, because they're so inextricably tied in how a company operates and what its impact is on the communities in which it operates, and how it thinks about its employees, and how it puts itself out there into the world that actually directly translates into shareholder returns, that it's not one or the other, that it's operating in this gray area. And that's why that's why my team exists, because what we're looking at is the materiality of these factors. If you have a company that is producing some waste that's having an impact on the environment, and that's making that company more money, well, it might be making that company more money in the short term to dispose of its waste in that non-environmental way, but that's not going to work in the long run when we have policies, when we have government, when we have fines, and we have lawsuits. That impacts the bottom line for long-term investors. And so when you're a long-term investor and you're looking at that, it actually ties very neatly together. That risk and return goes directly together with doing better for the environment and and the communities and the spaces in which companies operate. I do think there is a line from my perspective that where a company cannot be responsible for doing everything, for thinking of all the different areas where maybe in areas where they don't play, where they don't have an impact. They need to think about what's material to their business. How can they best direct their resources to do better for the communities in which they operate and in their impact? And I think as shareholders, that's what you want to see, because that actually ties closest with the risk return. So that's I think my perspective on that doctrine.
Perfect, thanks a lot. And actually, you're bringing me like a perfect transition for the next question. Like you said that the risk return objectives that you're facing, that you're trying to achieve, are well aligned with like like the incentives to preserve the climate and to like make sure that we are not too much affected by climate change. So I want to talk about when the incentives are aligned and when they are not aligned. Like I want to know, like, in your opinion, like when it does pay to when doing well is the same as doing good, and when it's not. For instance, like Warren Buffett is Berkshire Hathaway, so like the fund of Warren Buffett, they famously chose not to invest in tobacco companies. And like one of the ways they justified that, like quote, like we were better off not making a killing out of a product that we knew going in was a killing product. So what I want to say is that there are situations in which doing well and doing good, it will be aligned. There are also situations in which it won't be the case. So when does doing good like imply doing well, and what happens when you cannot do both? Like how do you like talk to your customers, to your investors, when actually you would have to sacrifice returns in order to preserve your ethical values? Perhaps Jasmine, you want to talk about that?
I mean, I'm gonna take a broader stance at that. I think we have to look and consider beyond what's on the financial statement, or in financial statements, or as part of bottom line. I think decisions are no longer being made purely based on the 100 to 200 pages of financial statements that are sent out. Sebastian, you just did a quick poll of the room. How many people have the technicalities to read the reports that are actually published by financial institutions? I think that our shareholders, investors, customers, they also get information from speaking with others, what's in the media, what's in social media. And so we need to start thinking about decisions that support reputation. We need to think about how quickly information moves. I referenced the GFC earlier, and that was back in 2007 and 2008. Well, that had ripple effect across societies. And so if we go back to what happened, well, there were systemic failures. There were concerns that were raised against global financial institutions as well as government institutions that were in place. It led to significant reform, the Dodd-Frank Act. It led to whistleblower protections. It led to a whole host of reforms just to build trust back. And I think trust was mentioned by one of the panelists earlier today. And trust is an important element. So we may be debating about the good and the bad, but ultimately we need to think about who are the constituents that we're working with and what is going to matter to them, how they're getting their information. They're going to think about sustainability and longevity. Is this an organization that's going to be around in 2 years, 5 years, 10 years? We talk about pensions, so absolutely that's something that's on someone's mind if they're making investments for a longer term period of time. And so are we putting in the right structures to think about how organizations are managing their risk? And ethics is a part of that. I look at ethics as a part of risk management and corporate governance. But all of that ties in, I think, in terms of looking beyond the bottom line, looking beyond financial statements.
Perfect. Sébastien, could you perhaps talk about what the academic literature says about, the choice between ethical values and returns?
I think there's nuances. It's actually fascinating because when you read the news, either you're going to get a statement as in green is good, and you can be green and have higher return, and it's unequivocal, and then you can read other news where you'll be like, no, actually, hold on, the green firms are overpriced, and if people start to be green in addition to being perhaps return focused, they're going to lose out. And so it's hard to see where the middle ground is. When you go over the details of the academic literature, you realize it's actually quite nuanced. So the first point, which I think is really important, is the more we as investors, the more we want to invest in green, more likely, the more we'll bid up the values of the green firms, the dark green firms in particular. The valuations are going to go up, and if the valuations go up, well, the returns will go down. Just because you pay more for the same type of firm, keeping the risk equal, and I agree, there's some climate risks that are really important here to take into account, but still the valuations will go up. It's like saying, you know what, I'm going to be in Toronto and everyone is going for the same types of new buildings and there's a limited supply of them, and so that raises up valuations. We pay much more for the same type of goods, so returns will be lower, and that's fine. That's the trade-off that we have to pay in order to be green. So that channel would predict a bit of a negative relation between being green and having returns, and we see it actually in some cases. We find that some of the greenest assets tend to be highly valued, and therefore if you buy them, you may have lower returns, but that's okay. That's the cost of buying a greener product. But then you have other aspects, and this is where you can find the alignment, I think, that you're referring to between green and having high return. So for example, if we take what I just described, where the dark green products are the most expensive, well, anything that you can do to bring an asset there likely will bring up its value over time. And so any transition type of initiative where you can take an asset that is brown and convert it to being green, it's risky in doing it, but it actually have potentially a decarbonization effect together with a greening effect. And you can have a higher return in doing this because the price at the end is actually quite valuable. That's one. Another version of it, which I think is why we've seen really good returns for the green firms or the well-governed firms in the past, is that, well, for a while, we were not as green as we are today. And so if investors don't care as much on the green side, perhaps they were undervalued for a while, but less so. I mean, we've seen a wave of green energy. Now we're having a bit of an anti-ESG pushback. But for the past 10 years, we've had a wave of green energy that has raised the valuations. Again, there we see an increase in prices, but potentially lower returns moving forward. And so it depends. It depends actually on where you position yourself on the green scale. If you're going in for the darkest green, already green type of assets, where that might already be highly priced and lower returns, as opposed to perhaps more transition assets that are on their way to becoming green. And then you can get different relationships between the risk, return, and green trade-offs.
Perfect. Melanie, I would like to come back to the notion that when you're investing only in a subset of assets, only in the green assets, for instance, you're operating under constraints that are tighter. It's more difficult. So it will be more difficult to achieve a high return. So how do you convey that message to the customers? How do you communicate that?
Yeah, and I think there's a couple. I think we need to break it down a little bit and think about this. And I think one important point, too, is that there's no clear line on ethics. And a lot of issues have different sides to them, and they can be very controversial, and it's not always clear that what side is the right side or the wrong side. Some of the environmental ones are, you could say it's clear. I think with diversity issues, it can be very clear, but we see things, we've had clients who want to divest from anti-abortives. We've had clients who are on opposing sides of the current situation in Israel and Gaza. We've had, you see the fossil fuel free. We've had, clients on both sides of those. And it's not our role to impose values on our clients. And that's where I think it's really important. And this is where, as an asset manager, we are highly, highly regulated. The client tells us what their investment objective is, and we will invest in accordance with what that objective is. It's not our role to tell them one thing or the other. And there's sort of two ways that I think about ethics. I think from my lens of, there's one is, what is the company doing? And are they doing well in terms of their own impact on the world and their own, which can impact their return? And then as investors, when we look at companies, how are we assessing these companies? But then also, how are we meeting the requirements of our clients if they have certain ethical constraints that they want to put on portfolios? How do we do that? When is it appropriate? How do we actually execute on that? And then, of course, when we vote our proxies and we engage with the companies, are we doing it in line with what we think the best interests are of a company? And so there's a lot of complexities there, and we do have a lot of really deep conversations with clients about what they're doing. A lot of our clients are big institutions as well. They're not individual clients with specific goals, but there's an institution representing a whole group of people. And so we want to understand, is what you're saying as part of your, if it's a pension, for example, your written investment policy, does that represent the beneficiaries that you have a fiduciary duty towards? And making sure that what they're doing is, lines up, and that if they want to put ethical constraints on a portfolio, for example, if you want to cut out tobacco, in the example from Berkshire Hathaway, what does that mean on the portfolio? What does that mean for the portfolio? And so what we do is we will run portfolios. We will run different instances of, if you want to have certain exclusions on your portfolio, we can do it, but you need to understand that this could be the impact on the returns if that is your objective. And so we will, of course, our legal team will get involved and make sure that it's very clearly documented about what the potential. Sometimes it's not that big of an impact, and tobacco, actually, to be quite honest, is not that big of an impact on most portfolios. It's not a huge part of the index. Fossil fuels are, and that was a big issue, and we've seen a lot of universities, and actually this is a good example of how it's being done. Universities where the student bodies want to divest from fossil fuels, but they can't necessarily impose that on the pension of the professors in place, because the beneficiaries need to say that. And so you get into the structure and the legal requirements around who dictates what can be spent where. And a lot of universities have gone fossil fuel free, but they've gone fossil fuel free in the sort of their operational funds or their student endowments. And so there's a lot of parameters around that you have to consider when you're putting this in place, what it means and how it can do it. And the last point I'll make, which goes back to the first point that I was making, which is sometimes there's not a black and white, and sometimes there's two sides to it, and people can have different stances on it. One is a very clear one on this is the defense spending. For years, controversial weapons were considered, non-ESG. If you had an ESG fund, you could not invest in cluster munition landmines. I mean, we have firm-wide exclusions against these, but then the list kind of goes longer and longer, like blinding lasers, depleted uranium. How far do you go? And then now what we've seen is, when Russia invaded Ukraine, money went back into defense spending. And we've seen a softening in Europe, which has, historically taken the strongest stance against controversial weapons. And they're starting to say, well, actually, we need to build defenses as a country. That's actually important. That's in our national security interest to be able to do that. We're sort of saying now it's and I'm not, I've seen some funds say, well, we're removing some of these restrictions from our ESG funds. We want to allow this money back into defense spending because we think that actually that serves the better public purpose. And so sometimes over time, ethics changes and how money is invested changes. And we need to be really mindful of that and careful that we're not too, severe with how we come down on these different issues because they change.
Yeah. Perfect, and I'm going to come back to that exact point very soon. Perfect. So now we know why finance might want to look beyond the balance sheet. I want to talk about another question, which is how should finance look beyond the balance sheet? Because it's a completely different question, right? So we talked about Friedman just at the beginning of the previous section, and as Melanie said, in 2019 there was this business roundtable meeting where actually US CEOs directly rebuked the Friedman doctrine, and they said that we should no longer only maximize shareholder value, we should actually try to do more than that. The problem is really what does it mean more than that? I'm quoting a New York Times article, and they said that the problem was that they were not very specific. They, the business roundtable meeting, the ideas were it was basically a bit short on the specifics. So I think it's fair to say that since then, most of the progress that we've made has been on the metrics side. For instance, just 15 years ago, you might remember that there was a wave of suicides at Foxconn, one major supplier of Apple in China. So that created a whole debate about worker safety, work-life balance, and so on. So if perhaps the progress that has been made in recent years, in recent decades, has really been on the metric side. And for instance, currently in the European Sustainability Reporting Standards, there are several metrics that are directly devoted to work-life balance, worker safety, and so on. So the first question I want to discuss today is it the right approach? Can we change investment behaviors by changing the metrics? Is it really the right approach that we want to take if we want to affect how finance behaves? I don't know, Sébastien? Or?
I'll be quick because I'm actually very curious to see how you've developed it at Deloitte and RBC, especially with the sustainability linked bonds and others. There's a really interesting academic study right around now, actually, 2024, 2025. And what they find is when they use sustainability linked bonds, that means these are bonds whose payoffs ultimately will be tied to particular KPIs set by the investors. The firms issuing these bonds tend to decarbonize, 7 percentage points faster per year than the others. So that seems to suggest actually that there is evidence that whenever you're creating products that are directly, or financing products whose terms are directly linked to, let's say, climate or social KPIs, real impact seems to take place.
All right. Melanie, about the use of metrics, how does it affect the way you invest, the decision that you take? What is the role of those metrics in your everyday practice?
And it's a good question because in Europe we saw a lot of demand for metrics and numbers, and we love numbers as shareholders. We love to, try to calculate things and figure out how this impacts the investment. And the Sustainable Finance Disclosure Regulation that came out in Europe required us to disclose a number of metrics across our funds and also at a firm level. But then it was just leaked last week, and they've actually, I think just yesterday, they released the final version of the regulation. They're pulling back all these metrics. We built out all the data infrastructure. We put a lot of money into how we report out on these pie metrics, which is not completely wasted because actually we've leveraged it for a lot of different uses. But now they're pulling back and saying, well, we don't really know, if we're reporting out on emissions, we're reporting out on, emissions I think is really important, but we don't exactly know what it means in terms of risk and return. We know that directionally this is where we want to go. How much weight do we put in that? in these numbers. And emissions is actually a good example, because when you look at the emissions data, it's usually old. It's usually at least a year old from a company. And it doesn't say anything about where the company's going. It is one metric from one point in time that says how a company's been in the past, and it's not a predictor of the future. And so you really have to take a lot of these metrics with a bit of a grain of salt. We also don't have consistent ways to measure a lot of these different metrics. This is very new. It's new science. With the emissions, we've spent a lot of time with the data providers, actually, because I have someone on my team who this is his role, doing the data and the research on that, and educating, hotel chains how they should be calculating their emissions. We see all kinds of problems with it. We see problems with how companies are being mapped to the parent entities. There's a lot of issues still with the data. And so I always think that we need to put a little bit of a grain of salt into when we look at these hard metrics and say, just because a portfolio is operating here, what you really need to understand is, if your portfolio has a lower weighted average carbon intensity than the benchmark, for example, why is that? Is it because the investment team is holistically looking at the companies and their strategies and where they're going? Or is it that they're just looking at the numbers and it maps out that way and it could change next month because it's not part of the overall strategy of how the fund's thinking about it? So I think I think that we still have a ways to go.
But could I quickly ask, how much of the bonds or the investments, the loans made by RBC increasingly incorporate perhaps social or environmental metrics tied, let's say, to the repayment? Are these still a minority types of loans, or have they made it more in the mainstream?
I think that they're growing, but they're not the majority yet, but it is a growing area.
Can I just add a comment to this? So I think in the world of ethics, metrics are sometimes not easy to determine, but it starts the conversation. We need ethics to be more tangible. So for environmental and for climate, I think it lends itself to be measured. Now, for the S and the G, that becomes a little bit trickier. But until we start to talk about this, it's difficult to put it into practice. They're great as qualitative aspirations, but to get the conversation started, to be able to look back, to see if change is being made, I think we do have to move towards metrics.
So a good example, I was talking to utility providers in Ontario, and they've recently started issuing green bonds. They were getting a better cost of capital so for the issuer it's good, for the investors perhaps less, but the issuers as a result borrow at cheaper rates. It was not a big difference. But the big impact it had for them is exactly what Yasmin said. Now they started embedding it as part of their framework. And it became a central topic, as opposed to perhaps a side discussion that they were not perhaps taking it as seriously. Now it has become just a central component of their operating processes.
Perfect. So metrics might be a way to start the conversation, but I want to push back a little bit on the use of metrics. Some of you might know the Goodhart's law. The Goodhart's law says that basically as soon as a metric becomes important from a policy's point of view, it becomes useless from an information point of view, because all the agents will try to game the metric. So for instance, we know that there is evidence that Amazon downplayed on the number of injuries in its warehouses in order to game those metrics. So I want to ask a slightly different question, which is, okay, we want to look beyond the balance sheet, but can we really trust numbers that are beyond the balance sheet? What is the level of trust that we have in those numbers, and do we have to audit those numbers the same way that we audit, the numbers that are on the balance sheet? Jasmine, perhaps you want to talk about that?
This is a very good question. And I think on one hand, we have audited financial statements. They're audited, looked at by independent, objective professionals. And so, yes, there is a higher level of trust. I go back to misinformation and disinformation. I'm not sure if it matters if we're talking about brand and reputation. So yes, for metrics, we can get to a stage where they're audited outside of the financial statements. But I go back to the reputation and other aspects of information that our investors, shareholders, customers may use. And reputation is important because we go back to how are people making decisions. There's an element of trust. So the Edelman organization publishes trust barometers and trust measures on an annual basis. Trust generally is waning across society. And we all have a role to play. Organizations, financial institutions have a role to play. And the results, the waning level of trust, it's a very sad perspective on our future. So what can organizations do to manage a world of misinformation, disinformation, as it relates to their own reputation? So one, yes, they can put more information out there and publish impact reports. They can release positive media articles and whatnot for what they're doing to enhance commitments to society and how they're helping their people. But I also think that they need to look at the risk management side and the governance side. How are they handling a crisis, for example? This is a world where disruptions have become a norm. There is a significant level of volatility. Is there a level of transparency? So we might have organizations that publish a whole bunch of missions and purpose and vision statements, but what do they actually do in practice? And that not only flows from how they run their business, but how are they managing the risk side? And I think that's where ethics really plays a role in that. And so in terms of other sources of information that people may look at, it could be how they're handling difficult situations. It could be the composition of their board. How many independent directors are on their board? So looking at the elements of governance that could provide a different perspective. I think this is important for beginning to, it's not beginning, but it's reinforcing that trust, especially within the finance industry. There's a role to play. Across society, most people, if not everyone, has a tie-in with a financial institute. So that role and that fiduciary duty, I think that is there. It's a basic. But the role that organizations play to continue to build on that is going to be an important piece. And that trust element of it, I'm not sure if it matters as much in terms of glossies and things that are put out as much as how are we conveying a message and being able to control that narrative so that when volatility strikes, when disruption strikes, that there's an ability to manage it and to demonstrate that actions match words.
So can I follow up on what you mentioned?
Sure.
The role of the auditors there. Auditors audit financial performance across the company. This is well done. Of course, it's a huge amount of work.
Yes.
They know how to do that. Now, increasingly, as the companies are showing perhaps their green and social efforts, especially as we're building with a taxonomy in Canada that will hopefully make that more concrete,
yes.
It's incumbent on the auditors, again, perhaps to do some of the verification. How difficult is it from the auditor's perspective relative to perhaps financial statements to do that type of verification and make sure that you're not ultimately thrown away and you can keep that credibility, knowing, as Melanie said, that there's multiple dimensions here that are sometimes receiving different interpretations on.
Yeah. So I don't work in the audit space anymore, especially not outside the financial statement audit. But I think that between the profession, the regulator, and the government, there's a role to play to make sure that there's consistency in terms of how organizations are measuring these non-financial metrics and how they're being audited and reviewed. So I know that there's standards out. There are a lot of conversations on this topic, but it's one that we need to keep alive because of the importance of others relying on information like this.
Melanie, I would like to come back to something that you said earlier. You mentioned that you have a climate change expert, like a governance expert on your team. Like, is it what it takes to really be, to make sure that you can trust the numbers, that you can, really understand the what's in those numbers and whether you should trust them or not?
Yeah, and I think, and actually I would say our analysts are on the investment teams the most highly equipped to be able to smell out if numbers don't seem right, because they're deeply involved in understanding the company and its strategy and its positioning. But sometimes you do need the experts to look at them, and it's new, some of it as well. We've had to look at we had to educate our data team. When we pull in all this data, if the numbers, we give them parameters, are outside of these parameters, then there's a problem. And sometimes we have to do a bit of a deep dive. A lot of the times, it's not necessarily the company's fault. Sometimes the data providers or where you scrape the numbers from, they're doing it incorrectly. Sometimes the company is, we saw with Bill C-59 recently, a lot of corporations pulled information from their websites and are continuing to do so. I think we're going to just continuing to see. And for those maybe not familiar with Bill C-59, maybe I'll back up. This is the Competition Act amendment that came through, and it was a small part of the changes that said that if you are saying anything environmental that is not supported by 2 international standards, and there's a number of other requirements, you can be brought in front of the tribunal by a third party. So not even the tribunal coming after you. Any third party can take you up there, and your penalties are tremendously high. And a lot of companies pulled information immediately down from their websites, especially numbers. And a lot of it had to do with the fact that in many cases there are not 2 international standards supporting some of these numbers. You know, in climate metrics, you know, we've been trying to everybody get around one, but we're not completely there yet. We looked at all of our stuff at RBC GAM. We went through our climate report and said, for every number we have, can we say that we're doing it, you know, in accordance with exactly how it should be, and we were comfortable that we are, and we did not have to pull anything from our climate report there, but it's complicated for companies to do that. And so I don't think companies are, generally speaking, I think there's always the odd one. They're not deliberately trying to mislead. And so if there's an issue or an error and we're a big shareholder, we can point it out to them and it will be corrected. I do think there is a role for audit as well, as we've talking about, and I think we are moving into that space where, you know, and I know the big auditors are much more involved in trying to audit these numbers, and I get emails and calls from them all the time, and we have used them, and we've used them for our impact fund in the US to say, can you audit us against our impact process? It's still really new for the auditors. We're still teaching them, and we're still sort of learning together, so we're not quite at the place where we've got that full type audit. But if it's you know, accidents in the workplace, that doesn't seem like it should be that hard to audit. And so I think that there's an opportunity there to bring some credibility to that type of data.
Yeah. Perfect. For the last question of this section, I would like to actually come back to something that you also said, like Melanie, and to talk about risk management, because if firms like start looking beyond the balance sheet and like incorporating like ethical considerations, like, well, as Melanie said, like one problem with like ethics is that it can change over time, and like defense was basically like a no-no like 10 years ago, and for ESG investors, I mean, nowadays, like there is a push to actually like be able to like invest in defense companies, because our approach to defense and has changed because of the Ukraine war and so on. So, like, how does, you know, like looking beyond the balance sheet like change our approach to risk management? Do we have to care about? Do you have to care about, you know, like changes in ethical values? Like another, I think, related question is that all those ESG metrics, they relate to very like you know, like long-term risks, such as, you know, like risk to climate, like associated with like climate change and so on. So like, does it, like caring about those metrics, like does it force investors to think more about the long term? So how, in general, does it change the approach to risk management? Melanie, perhaps, or?
I could start. I'll probably defer to my co-panelists here on this one, but I think absolutely it changes the approach to risk management. I think you have to look at all these factors because they all have a role to play. If a company's not doing well, on one of them, you might have legal risk, your reputation risk, regulatory risk. All of those things come into play, and they all have a ultimately financial impact on the company. And so and we do that in our risk models. We have embedded in it different, climate indices or metrics that we look at. It doesn't necessarily mean it's going to swing how you invest, but it's an indicator of something to look into and to do further research on. I think it's really, really important to be aware of this. But the last thing I'll say, it's really, really hard. I work a lot with our risk team, and they sometimes want to have a crystal ball. Well, what do you see? What is the biggest ESG risk coming down? What's the next thing? We saw in the first Trump administration, private prisons, which wasn't really on anybody's radar, suddenly became a huge issue because of the human rights issues that were there. And at the time, we actually divested from any private prison holdings that we had in the U.S. It was not before then on anyone's real radar. And so sometimes these things just sort of they fall out of the sky at us, and we, you know, what is the crystal ball? And it's really hard to predict. We didn't expect. Well, some people would say that they did anticipate. Some people in my firm say that they anticipated the Russian invasion of Ukraine. But whether you anticipate, you know, but for most of the world, I think it was not expected. And with energy security questions and concerns and everything that fell out of that, and then the defense spending, it's very, very hard to predict. It's hard to know what the next big thing in this space is going to be. I think it's human rights right now. I just don't. It's everywhere, all of these issues, and how we measure human rights, we haven't solved.
I'm happy to add to that. I think investment into risk management practices and governance protocols, like, it is part of ESG reporting and broader impact reports that are published, but it's really important. Does it have a direct impact on the bottom line? Well, it may not immediately, but to avert certain risks, especially for crisis and volatility that we've talked about, absolutely, it protects the bottom line. And so I think that it has to be built into financial institutions' operations. And largely it does, because this is a highly regulated industry. There are requirements across conduct, risk governance, as well as in terms of reporting. And so being mindful, not only from a compliance perspective, but the fact that this is protecting the longevity and future-proofing the organization, I think we have to build in risk management. And I'm not a little bit biased here. I do believe it does protect the future of an organization. So maybe adding a little bit more to the next question.
Yeah. Perfect. So let's move on to the last part of the panel. So, you know, like we said that finance should look beyond the bottom line. We then discussed how it should look beyond the bottom line. And at the end of the day, what it means is that finance has a role to play. Finance has a role to play to, integrate ethical considerations. So that means that finance has a responsibility, but I want to talk about, toward whom, because as we talked already about the business roundtable, and Melanie also mentioned the fact that our approach to ESG has changed recently, but Larry Fink was present during the business roundtable. He's pictured there. And he said in 2023 that he would no longer use the term ESG, that has become too, because it has become too politically loaded. Nowadays, we know that the Trump administration has, is not very keen on ESG funds. So I want to ask a slightly provocative question, which is does ESG belong to the past? How do you react? How do you deal with the shift towards ESG that recently? How do you react to that?
So I think the term ESG now belongs to the past. It's becoming too politicized at all levels, and it's going to be hard to continue keeping that term. The practice, however, is not. The practice continues. In fact, not only continues, for one, we have no choice because we are absolutely going to face a climate crisis in the decades to come otherwise. So this is inevitable. It's a steamroller coming our way, increasingly so. But I think increasingly, though, if I'm trying to look for a silver lining in what has happened in the past couple of years, is that funds were very quick in using the term ESG and saying we're going to be ESG left and right, we're going to put some big net zero targets without necessarily understanding the consequences that it means for operating costs, for practices, for overall management of the organization, the reporting standards is what it means. And today there's a bit of a clarification about the purpose of this and what it actually means. So increasingly now you're having perhaps less discussions about ESG, but greater discussions about climate risks, directly embedded as part of the portfolio. You're having directly the G as part of the good business coming in. So I don't view necessarily the practice as going down. In fact, it's more silent today for the reasons that you've mentioned. It's going to continue finding its way in the organizations, but perhaps in a much more meaningful way. At least I hope so. The term itself, I think, is going to suffer in the coming months.
Mélanie, do you want to?
Sure. I think we're going to replace ESG with ethics. Isn't that what we're all here for today? I think it is undergoing a rebranding, but I completely agree that it's not going away. I think, but it's evolving, and that's what's made it really interesting. Actually, over the past 7 years, I feel like I haven't been in the same role for 7 years. I feel like it's changed so much, but where I see it going, and I spend a lot of my time when I'm thinking about the strategy for my team and what skill sets do we want to add, and how are we thinking about this going forward, is everyone's gotten more sophisticated about this. Nobody really questions, well, what does WACC mean? If you are, it's weighted average carbon intensity. But in this space, we all have the same language, and we all are talking about it. So what's next? Next, to me, is using AI, and how can we use AI to look at some of these metrics, and to not only are we looking at it in the investments, but how do we use AI to bring more alpha? How do we use AI in this particular space? And we're very involved on my team, and I know RBC is really involved in the AI space, about how we can think about it, how we can better position portfolios going forward, how we can better analyze and do this kind of stuff. It's like we're just deeper in it. We're just more sophisticated about it. We're more thoughtful about it. I think the conversations are more nuanced about where it's going, but it's not going away. It's just getting better, I think.
Perfect. So let's move on to now the question of responsibility toward whom. Behind the idea of ESG, I think the idea is that we want to promote good practices, and to serve the public good, but there is a growing disagreement on what we mean by public good. One example of this is Sebastian and I were researchers in finance, so I wanted to give you an example of a research paper in finance. So our colleague Marcus Painter from the St. Louis University, he studied the effect of at some point Walmart stopped selling guns in the US, or at least a subset of guns, and it had actually a negative effect in Republican countries on traffic, but a positive one in democratic countries, so counties. So you see that there is growing disagreement on what firms should do, and for firms and for investors, it's probably a conundrum. So the question I want to ask you today is how can finance deal with increasingly polarized views of the world? Yes, it's great to serve the public good, but what do we do when we disagree on what it means?
So that's the fundamental paradox. On the one hand, you can have everyone investing for themselves, but then as we talked about at the beginning of the discussion, we end up in a very fragmented, disengaged ownership base. So there's issues there. Or we can pool together, right, and be much more proactive. But if we pool, now we're going to have a coordination problem because, the managers of the fund are going to have to invest on our behalf. But if we disagree, then how is the fund going to act, right? So if we're a trustee of such a fund, we have millions of individuals and they all behave different, they all have very different values, it's going to be very hard. In Europe right now, there's a new law for the pension funds that they have to understand explicitly what their members want. Understand explicitly what their members want. You have potentially hundreds of thousands of members. How do you do it? Through surveys? Surveys, as we all know, especially when we do our course evaluations, we're getting, 5, 10, 20%. The happiest and the most angry students, you're going to struggle getting some of the representative views from the classic tools. So to me, there's two solutions, two ways around. The first is to make use of a competitive landscape. So individuals can pool, but they can choose which funds they want to go to. So for example, in Australia, in the pension fund business, I can choose which they're called super fund, retirement funds, I can choose which ones to go to. So if I don't like the way mine is managed, I can look for one perhaps whose values is closer to mine. So that keeps the power of the large funds, yet gives individuals the options to leave if they wish, right? The other option is to be perhaps more proactive in understanding what our members want. So surveys are hard, but we don't need to stick to surveys. There's a new initiative being done at the moment in the Netherlands. One of the pension funds in the Netherlands called Desautels last year created what they call the Democratic Citizen Assembly. And it's really interesting. So they brought in about 50 people, representatives from the members. It's a bit like a jury duty. You're picking 50 representative members from the pool, coming in, training them for a couple of days. It's important to train them because otherwise, how are they going to fully appreciate the different trade-offs associated with the different options? They get to choose how they want to be trained. So they get to choose whom they'd like to learn from during these days. They get to talk with each other. They get to talk it out. And at the end of the 2 days, they can come up with recommendations. It's not a binding recommendations, but it's a set of recommendations that they believe on behalf of their members the fund should do. And so that's interesting because then the board now has a perhaps greater ability to act, especially in favor of the silent majority that may not speak out too much on surveys, and it gives a lot more confidence to the management team to act on their behalf. So that would be another way to go, perhaps to deal with more polarized views, which is to take the extra mile and understand where's the middle ground.
Perfect. Like, Jasmine, you want to...
Sure. I'll share a perspective more from a corporate governance lens. If you'll indulge me, as ethics officer, the topics that have dominated the agenda started with #MeToo, George Floyd, COVID, health and safety, to Russia-Ukraine war, war in Gaza, politics, whether it be in the US or here, federal elections, and now technology, AI. And so the topics that are going to come about and the disruption, that is going to be a different topic, but the volatility and the fact that they're polarizing, that's not going to change. So as an organization, we need to start thinking about, from a risk lens, to be more practiced at handling disruptions. So what I mean by that, it could include things such as identifying risks early. What does the emerging risk frameworks look like? How do we manage mitigations? How do we develop a framework for consistently addressing the new topic at hand? So I think that the fact that there are polarized views, that's not going away. But organizations need a better way to manage the risks of that. Having board and senior levels of management talk transparently, so that there's conversations grounded back in values and being able to practice through scenarios on what would an organization do, because sometimes there's not a lot of time when there's an issue that pops up. From an ethics perspective, again, focusing back on values, on societal commitments, that'll help organizations navigate when do they respond. I think oftentimes leaders jump to how quickly they should respond. They need to first pause to think about what are their commitments and what do they need to respond to. I think that many leaders have learned, just all of the polarizing topics that I listed earlier, leaders have learned that the quickest and the fastest to respond may not be the best solution. It's easy to look back in hindsight to go, well, what could we have done? And that's where scenario planning and a strong communication between board and senior leadership is going to help with preparing for situations like this. And I think that that's where the risk views, the ethics views, that does need to flow through an organization to the investment decisions that are being made to, again, reinforce the fact that there's a genuine approach. But going back to this topic, I think that we can't lose sight of the fact that there was a topic of risk raised earlier, and the ethics lens. How do we start educating on what ethics looks like, and how do we build that into practice outside of a code of conduct or a set of principles?
Lenny, do you want to talk about how you reconcile the different preferences of your customers?
Yeah, and I think when we've seen the pendulum swing in all the different directions, and what has kept our focus is we just sort of focus on our due north, who we are, why we are doing this. And even actually when the pendulum was swinging and people were talking about this, we just actually, and my marketing team and I would sometimes get into some debates because we wouldn't want to oversell anything. We're doing this for risk return reasons. We're doing this because we're fiduciaries for our clients, and we're doing this when it's a material issue for the company. We don't view our role as more than that. That's exactly what we're doing it for. And if you stay true to what that is, it doesn't matter if everything's spinning around you. You are on solid footing. You are looking out for your clients. That's what you're there for, and you really can't go wrong if you're just being your authentic self in terms of the purpose of your organization and where you are. And then, you're free from the regulatory issues that might happen. And it can swirl around. Doesn't mean you don't sometimes get caught in it a little bit and have to deal with a lot of those issues. But we always go back to, is this in the best interest of our clients?
Perfect. So to conclude, for the last question, so we talked about responsibility. You know that there is one famous quote about responsibility, from Spider-Man. So with great power comes great responsibility. I want to build on that. There is no responsibility without accountability. So I want to give you it's a hard question. I don't know to which extent you have a concrete answer to give me, but I want to know how at the end of the day we can really determine whether finance is looking beyond the bottom line. How can we say, well, yes, finance played its part and really tried to, change its behavior and so on. What would be an objective criterion to determine that finance is really looking beyond the bottom line? Sébastien, perhaps you.
So, the way I go back again to a point that I've made a couple times. To me, the question is, what are the institutional features of our financial system that can best mitigate these frictions that we've talked and can really leverage jointly our power? And I'm on the investment side, so our power as investors. I personally find that we have a lot of investments that are very fragmented. It's so fragmented and so short-term that it ends up focusing too much on the short-term return piece, and investors don't think about their role as stewards. They don't internalize their broader impact actually on society. You can eliminate some of that by creating more pooling structures that are more efficient, more long-term driven, less affected by capital flows coming in and out, and where you can you can have more explicitly that those long-term positive externalities. So to me, it's a question of governance, and it's a question of finding the right societal structure that allows us to leverage that power. There are systems out there that have been able to mobilize savings in a very collaborative way. I'm finding, for example, in Australia, the way they've created these large super funds means that, well, today, actually most of the savings, about, 2-4 trillion of savings, are managed by 6-7 large non-for-profit organizations with profit for member structures acting on behalf of their members. They're long-term, they're efficient, they're having the ability to make impact. And I actually find that so much more efficient than a purely fragmented system where we said choice, choice, choice. But because we end up not choosing, well, we end up leaving a lot on the table.
Perfect. Melanie, what would be a criterion, a change that you would like to see to really say, we are really looking beyond the bottom line. We're integrating ethical considerations.
Yeah, I think I'd start by saying that actually, if finance can't bear the weight of all of this on its own, governments and regulatory bodies need to be involved. We are highly regulated organizations in a highly regulated sector, and so we need that partnership. We need that kind of a thing. But if you want to understand better what your financial institution is doing or what your investor is doing for you, find out exactly what their process is. How do they think about these things? Ask them these questions. They should be able to answer it. They should be able to walk you exactly through their process and how they think about these different types of issues and values and how they're investing it. And then you'll have a better sense of what they're doing and what that organization is doing. I think getting into the detail of it is what's really key.
So I just simply look at, do their actions match their words? Are they making strategic investments into longer term initiatives? Are they investing in communities and projects that support people? How are they treating their people? We talked about DEI earlier today, but how are they treating their own employees? And so I think I look to actions.
Perfect, that's the perfect conclusion. I want now to open the floor to questions. So like, if you have questions for the panelists, like, yeah, raise your hands, and I guess there are mics or...
Hi there. Thank you for the wonderful panel. Isabella Tyke from National Bank on the Sustainable Finance team. My question is maybe to Melanie, to your point, with ethics changing over time, we also see ethics really changing across geographies. So in the context of fiduciary responsibility and duty changing south of the border, but here we're seeing, CPP facing litigation for not taking into account climate-related risks and opportunities. How do you consolidate? What does it mean to be the fiduciary? How are you grappling with those challenges? That's my question.
Yeah, I think it's a great question, and one we're always grappling with because we are a fiduciary and that's our primary responsibility. And in the US, it's interesting, a lot of our clients, we actually serve clients more in New York and California. That's where most of our clients are. So our clients have a certain angle to them, but even in the states where we've seen, the states that are traditionally more Republican, because that's where we're seeing this. I'm not trying to be political, but it's true. And but our clients there still want us to look at ESG because they believe it has to do with risk return. They want us to be looking at these factors as part of it. They don't want to put it in the agreement that that's part of it, but they do want to know that this is part of our process to look at the environmental, social governance issues. And even in the US, in most cases, we're starting to see even actually a little bit more pushback against this. If you tie it directly to risk and return, it is part of the fiduciary duty. And there's been a lot of legal opinions on that if that's what it's tied to, then these clients of ours in the US, they're okay. It's how they're wording it. That's how they're getting around it. It is coming to a head a little bit with Europe. For example, in Europe, if you sign an investment management agreement with a client, you have to put all this certain ESG language in. In the US, they don't want that language in. They still want you to do it, but they don't want the language in. When we're global, so sometimes our US clients are contracting with our UK entity, and then we start to, so it's a lot of legal teams involved in what that language looks like and what the client looks like. But it's really, if it is about risk and return, that is your fiduciary duty. If that is the investment objective of that particular client, be really clear with the language. And generally we've been okay, but I will agree with you. It hasn't always been easy. We've certainly been on many calls with our legal team to make sure that we're, above board in our language and how we're structuring different agreements.
A question maybe for Sebastian. Putting together the last question that we were looking at, how do we collectively know whether finance is looking beyond the bottom line? And Sebastian, what you were talking about, the pooling actually of funds, I'd love to get more perspectives on what we're seeing as the rise of passive investing. And I think by orders of magnitude, this is way bigger than sustainable investing or anything else. And how do you, and maybe others as well, from a risk perspective, from an asset management, which is more active, maybe by default perspectives, how do we think about that? And is it, we're just denying accountability or responsibility by going passive, or are we just buying into all the risks that we may see? How do we see that with the lens of sustainability or ethics?
So you're entirely right. The rise of passive investing has been huge. It's a revolution in capital markets. I think if we look at, I don't have the exact numbers in mind, but if we go back to 2000 to now, it went somewhere from 2 to 3% to 55, something along those lines, percent of assets under management. So it's huge. On the one hand, it's great because much cheaper to invest passively in large benchmarks than to pay 2% for oftentimes closet indexing types of strategies. So in a way, it has cleared up a lot about the role of the passive component versus the active component in asset management. So that's great. The fear that I have is that the passive investors are not good stewards necessarily of capital. Perhaps not as good stewards as active investors could be. In fact, it's really interesting, when you look at the large pension plans, they've gone a lot more in private markets over the past 20, 25 years. And it's not just a story of risk return per se, it's that they actually have a lot more control. They have controlling rights. They own 50, 55, 60%, 100% of the investments. And so from a stewardship perspective, it's a lot easier to make change than if you are diluted a tiny fraction, again, of a fragmented ownership base. There's research, maybe Paul, you know some of that research. There's research that when you look at the passive indexers, there's not as much, perhaps, stewardship that perhaps among the active investors. Increasingly, we've seen some of these passive investors now bringing back the votes all the way to individuals, which in my view is bringing back to the issue of, well, we can vote, but we won't. So it's not helping in that sense. So that's the fear is, are we becoming less engaged as passive investors? There's a big question mark there.
Yeah, so to come back to your point, yeah, passive investors are way less likely to engage, which is expected, I guess.
But in another way, if you are a passive investor, you are free riding on everything else. So if the active investors on the other side do their job, right, they will have disproportionate voting power. So then the question is, are we okay with that as a society? To have, I'm passive, I'm not going to do that much, but I know that whoever is active is going to be much more engaged. There may be something there, but that's a topic I think we need to address very carefully, because you are effectively giving up a little bit of your vote by going passive.
Just a different perspective on that. From just an ethics angle, I think passive investment makes finance, investments, etc., more accessible for everyone. You don't have to be an expert. You don't have to understand how to read financial statements to participate. And so I think that helps level some of the playing field.
And thanks to this panel for your insights to the question of should we look beyond the bottom line? The answer seems to be lie on no. So we should look at some other issues like ethics and other responsibility risk. So this leads me to two questions for the panels here. So the first question is, to the extent that ethics and other risks are important, so what are the major sources you guys are supposed to collect for those information, right? Where do you grab those data on ethic issue, on the responsibility risk, etc.? That's the first question. And the second one is, given that you have identified those risks or those issues, right? How are we supposed to integrate into the valuation models? How are you going to process it? Is it a cash flow risk, discount rate, or whatever you're going to integrate into your business model? Thank you.
Do you want me to start off with that one? I'm happy to. So in terms of where we get our data specifically, we use both Sustainalytics and MSCI, and we pull in their data. They also have controversies information. They have research on companies. For proxy voting, we get our data from ISS and Glass Lewis, and we make our own determinations based on that information. And then also company websites, all the company and corporate disclosures, and also through our engagements with the companies. And in that kind of information, we're not learning anything that's not public already, of course. We're not becoming insiders, but we understand better their strategies and how the company's thinking when we do those engagements. In terms of the question on how does this flow into the cash flow and the financials, that's sort of one of the biggest questions in this area. If we knew that this exact emissions number was going to have this particular impact on the balance sheet, that would make life simple and straightforward and easier. There are standards like SASB, the Sustainability Accounting Standards Board, has put out a framework where they look at material ESG factors for each sector and they map them against where they might show up. Was it the balance sheet? Is it the income statement? How might that actually play out and be tied into the financial position of the business? but it's not, a clear formula quite yet. And so that's why, and that goes to my point earlier, where we can't just say, well, this is going to be the direct impact on it. We have to understand it, the company and its strategy more holistically.
Any other question?
Lawrence Krzyzanowski from the John Molson School. You talked about passive investor. There's a more global concept of common ownership, where you have to look at not only the impact on the firm you're looking at, but all other firms in the portfolio. And common ownership is much higher than passive ownership. What's your thoughts in terms of that?
So when you look at these large institutional investors, they are common owners in the sense that they own significant shares, still in the case minority, but of the whole portfolio. In fact, there's been a whole set of academic studies on this. One of the ethical dilemmas is when you are a common investor, right? Suddenly you may have some, so do we still have a competitive market if ultimately you are the sole investor? So imagine, for example, that you are, you own all the airlines, right? Sure, the airline market is competitive, but they go back to the same owner in the end. So it's an extreme case, but there have been academic studies showing that actually when you start having too much of a common investor consolidated, you may actually start losing some of the competitive aspects of the markets. So I think you're entirely right that there needs to be some guardrails against having too much concentrated ownership, I guess, from common investors that own potentially competitors and start to create a bit more of a monopolistic structure in the economy. And it's not that visible right away, right? You have to uncover it. There's a risk there.
If I could ask another question. I've looked at a lot of these metrics and used them in research. And if you look at raters, for example, bond raters, they do a lousy job. They've had all kinds of problems. For example, a good example is Canadian Maple bonds that were rated AAA. Within a year, they were junk bonds. Okay? If you look at ESG, CSR ratings, the correlation between the different rates are very low positive values. So how can one have a lot of, do these things have a lot of merit? How can one have a lot of confidence in these ratings?
So I'll start by commenting on the second because it reminds me of a point Melanie made earlier. The ESG metrics, they're not easy. There's many possible metrics, and our interpretation of what's good and bad can change. Some of them might be backward-looking, some of them might be forward-looking, and I was struck actually the first time I looked at the MSCI, let's say ESG ratings. I don't know how many variables there are, like 200, 300. I mean, it's massive. And so it's not that surprising that if you're going to start comparing one ESG rating provider to another, you're going to get very different types of ratings. It almost reminds me sometimes of university ratings. We have the QS, we have the time, and then they all rate each other. And of course, you pick the one that you look the best at. It's a bit of the same here, but it's not clear to me that it's a bad thing. Because if investors do differ in their values, if anything, they can look at what ratings make the most sense for them. And if anything, what we don't want, going back to the whole Paul's question on risk and return, what we don't want is a situation where all of capital goes the exact same way. If anything, that's going to push valuations high up. But if you do have investors with different ESG values spread out around the world, looking at, as a result, different dimensions, if anything, you may create an impact without creating as much of a pricing effect. So if it may bring down any of the cost effect of ESG as a result because of that. So I don't necessarily view that part as a limitation.
But if you sat on a pension fund committee and you use one metric, and other metrics give you different opinions. You have to worry about your fiduciary duty.
That's true, but I think going back to Melanie, if you know what your North Star is and you make a strategic decision about which are the values that you care about, I've seen many pension funds in healthcare saying no tobacco, that's a values for us. Okay, fair enough, that makes a lot of sense. And then so you stick to the ESG values, the most important to you, or the UN SDG goals that are the most important to you. What's important there is that you're consistent over time into it. Right? You don't keep flipping depending on whatever looks best one year or next. So it's really important to have that strategic discussion. And in fact, when I'm looking at the fiduciary duty, what I'm finding fascinating across the funds is that the fiduciary duty is often written in a very vague way. Do what's best for your members. But I mean, what's best? What do they want? And so it actually forces you to think strategically, to talk to your members. And different funds may come up with different answers depending on, I don't know, the socio-economic conditions of their members and what they care about. But what's important is once you've done that exercise, then of course you may evolve it over time because the ethics the situations may change, but you do it in a way that is transparent and that is consistent to your own values. And I think that's, if you do that, I think that's okay.
Can I jump in there too a little bit, just on the metrics? And I think it's really dangerous. The metrics, I get really uncomfortable when clients come in and say, well, we want to rely on this one metric because it's so different. And we did some research about 2 years ago with our quant team looking at gender diversity in the Canadian market, and do companies who have more gender diversity both in senior management and on the board, do they outperform other companies? And what we found, and I don't usually like to talk about this, but it's actually no. It's very marginal, except in Canadian mining companies. When they have more gender representation, they do outperform. And so that is actually, it's one of those, it's so nuanced that if you applied that all the way across, you wouldn't, but actually it depends on the sector. It could depend on the geography. It could depend on all of these different variables. And so that's the danger in taking a metric and just using that one metric across the board. It has to be has to be thoughtfully looked at in terms of the overall portfolio.
So one question there. We cannot hear you very well.
Okay, sorry. Okay, I think we can all agree that Warren Buffett is one of the greatest, if not the greatest investor of all time. Now, when it comes to investing, in his annual letter to his shareholders and at the annual general meeting, I don't think I've ever heard him say that I invested in a company because they have good ethical standards or they follow good ethics. I think because you can have good ethics or follow good ethical standards and you can still massage those financial statements. Whereas Warren Buffett looks at the integrity of the management, because if the management is operating with integrity, it's less likely that they're going to massage the numbers on the financial statements. So I guess my question is, isn't it more important to be teaching future managers or managers how to operate with integrity rather than focusing on following ethical standards? That's my first question.
But can I return the question to you? If you are training your managers to focus on integrity, they will likely be more ethical in the end, no?
Well, that's it. Whereas if you focus on teaching them just ethical standards, they might not have integrity. That's my point.
Ethics and integrity to me kind of go together. If somebody's going to have integrity, they're going to have good ethics, and vice versa. So to me, I think it's kind of part and parcel of the same idea.
I think for me, it's the practice of it. So learning about the standards and learning about what you should do in a rule book is one thing, but practicing it through scenarios and testing it and debating it, discussions, I think that's what helps bring it to life. And I agree. I think ethics and integrity, I see this as very similar, and there's an overlap, but I think it's the practice that brings it to life to deliver better managers.
Okay, I mean, it sounds like it's the chicken and egg thing, what comes first? Okay, my second question is, with regards to ESG, I'm going to focus on the E, the environment. I think the focus with the environment is the emission of CO2, but I think the bigger problem is pollution, whether companies are dumping their chemical waste into the waterways, microplastics, air particles in the air. Isn't air pollution more important than the emission of CO2?
Can I take a first cut at this? I think that CO2 emissions have gotten a lot of publicity because we found a way to measure them. We've sort of come together across some global standards about how we think about these, how we measure them. They can be audited, and so that is one. And also, it really goes to materiality. CO2 and climate change impacts all sectors. When we talk about pollution in waterways, it impacts certain companies in certain sectors, beverage companies, for example, and their wastewater and how they're doing that. And so it's not as uniformly applied or thought about as emissions, but they are both incredibly important.
I think we are out of time, so I would like to conclude, and I would like, more importantly, to thank our fantastic panelists. So please, let's thank our three speakers. And I don't know if you want. Yeah.
Thank you very much. It's a fantastic panel. And to the questioner in the back of the room, as a person who teaches ethics in our faculty and just taught one of those classes yesterday, the primary concern was integrity in that class. So just so you know, this is the way that we think about ethics. We think about, and the way that we teach it here in the Faculty of Management and at McGill, we teach it integrity as foundational to ethics and ethical comportment. So we take your point and we're on it. We're thinking about it. So for those of you who don't know me, I'm Lindsay Holmgren. I'm the director of the Laidley Center for Business Ethics and Equity. I'm a professor in the Faculty of Management, and as you know, with Nikita's idea and my execution, founded the concentration in ethics, which was launched this year. So first, I'll just say thank you very much to all of the panelists and all of the moderators who participated today. It's been nice getting to know you a little bit, having conversations. I got to know most of the panelists and got to know sort of their positions and the way that they're working on ethics in their organizations, and that was a real privilege. And I'll say that it's fascinating how iterative and diverse all of your approaches to managing responsible investing and ethics and sustainable finance are. We've talked quite a bit about semantics, right? About the language that we're using to describe what broadly can fall under the term ethics. And I guess I would say the language we're using is varied and sweeping. Again, to this question of integrity, one of the terms that might come up. What we mean by DEI, sustainable finance. But I would say that every word and every thread, whether it's called ESG or it is ESG, whether it's called DEI or it is DEI, what matters is that it has value and that it's real. It's not window dressing, to use a term that Andrea used earlier today, or greenwashing, but action, regardless of how we're describing it. Related efforts move finance in the direction of responsible investment that demonstrates alignment between language and action. As several of our speakers, including Jasmine, Andrea, and Vanessa, made clear today. It's that alignment. It's an alignment to your question. Again, alignment is integrity. These are the integrity of one's actions and one's claims are alignment. Moreover, as Melanie rightly notes, ethics itself is unclear. And an education in ethics at McGill is a means of raising ethical awareness, and it needs, above all, to encourage people to pause and think. We understand that we don't all share the same ethical commitments, and our definitions of what it means to behave sustainably or what it means to do the right thing or the wrong thing vary from person to person. So an education has to help people to think through what those things are to them, and above all, to enhance our capacity to engage in civil discourse, in dialogue, in the ability to talk through what those commitments might be for each of us, which would help fiduciary organizations to accommodate some of those ethical commitments that different people have. We're all responsible, which also came up today, for our commitments, our ethical commitments, and how we comport ourselves. Sabah called attention to the people who didn't care during the pandemic about the impacts that they were having on others. And I would just add here a little something about my own research. So as part of my research, we've interviewed 430 recent graduates and students across Canada. Part of that interviewing process was done during the pandemic, and this is something that we saw, that different students from different demographics were suffering in very different ways as a result of what their personal experiences might be, what their privilege might be. We all have to take responsibility, and this is something we see in the financial sector. So to use Vanessa's observation, finance is the invisible architect of reality. I thought that was a lovely line, and we have to think about the ways in which our own actions, to Sebastian's point, as shareholders, in which we can participate in comporting ourselves ethically. So what I've found in the process of creating a space in our faculty as director over the past 3 years of the Laidley Center, I will say that it seemed to me when I first arrived that there really wasn't anything going on in ethics in our faculty. It wasn't something that people were talking about. It wasn't sort of a central concern, because the term ethics was the term that might have been a bit of a challenge. But when the space was made for all of our shared efforts to start to come forward and rise up, and our collective shared goals became more visible, in fact, it showed that we all, or at least a large swath of us, were already committed to ethics in various ways. And the terminology was just the challenge. It was figuring out those shared concerns that we had. And now we have an opportunity, thanks to David's endowment. David Laidley sits here with us today. We have an opportunity to try to bring those to the fore. As Toby Heaps put it, what gets funded gets done. And Vanessa called attention to the importance of education in our classrooms. And I will say we have a seed grant program that we started a year ago from the Laidley Center. And in that seed grant program, every member of our faculty, regardless of rank or area, how experienced they are, every member of the faculty has access to funding to help embed ethics education, whether that's values-driven, sustainability-driven, DEI-driven, to enhance the ethics education in every one of our classes in our faculty. So I do think, and I strongly believe, that that's an important way to start enhancing ethics in all of our graduates. And I personally do go out, I believe, in another observation that came up today, that educating much younger people than at the university level is very important, which is why we invest in Ethics Bowl Canada, which is, and why we brought Ethics Bowl Canada to Montreal and to McGill, the French Ethics Bowl Canada and the English Ethics Bowl Canada, because that's for high school students. And I've gone out, this goes against what sometimes might be the primary goals of a person in a university, but I do go out and I also speak to high school organizations about the importance of ethics, because I do think that it's crucial that we're talking about these things with our students before they arrive in university and decide what they want to do. So with all of those observations in mind now, I'd like to say, us being here today, this is evidence of how committed we are to the broad scope of what we call ethics, however we might define that and however different our ethics might be from one person to the next. We're concerned with our values, We're interested in listening to one another, engaging in this dialogue today. We listened carefully. I heard people speaking to one another and listening to one another in ways that raised up shared ideas and shared concerns. Finally, I'd like to thank the people who made today possible. So obviously, I'd like to thank, you've seen our team running around. Owen and his partner here have been running around taking photos. Stuart has been recording, and his team, Jamie's been here as well, helping us with our audio visuals. Thank you for that. The staff here at the Faculty Club, thank you for everything you've done. And especially the engines that drive this machine, Nikita Boston Fisher and Joelle Moses, both of whom you've all heard from at some point or another as we've worked through all of this. And Joelle, thank you for your outstanding outreach that brings everyone here. Thank you very much to everyone for today, and please keep talking to one another, keep thinking about ethics broadly construed, and let's start doing that in the next room with food and drinks. Thanks very much.